Hello and very warm welcome to the home of high probability trading. My name is Tim and I'm one of the traders here at the Live Trade Room, and you're very welcome to join us for what is very likely to be a volatile trading session. We're looking to trade the US Open and we'll put everything in place necessary to try and track and identify those high probability trades. And during the broadcast, if we get to pull the trigger, you'll see us trading these markets with real capital live as well. So for those of you that are genuinely interested in learning how to trade these financial markets, we can certainly help you as an organization. We've got a wealth of education and live trade rooms and things like that for part-time and those that have a little bit more time during the day to trade day trading opportunities. Then we do absolutely cater for both types of trading availability. So for more information, just go to a website, thelivetraderoom.com, and feel free to get in touch with us here through the chat function, even if you wish. Okay, so let's get straight into it then. We'll put our plan together, we'll put it up on screen. You'll be able to monitor and track those trading opportunities, and I guess the idea is to kind of explain the context of the trade and try and inform you as much as possible in terms of the reasons for getting into those trades, why we're selecting those trades over other trades, and let's see if we can make some cash for the session. So without further ado, if we just start with a risk warning briefly, please take a brief moment to familiarize yourself with our risk warning currently up on the screen. We've got a major news event today, so we've got the ECB. So we'll have the monetary policy statement actually due out in about half an hour now. So let me share this info with you. So major news event for the Eurozone. So we'll have the ECB with their monetary policy statement due out at 12:45. So in about 26 minutes. And then we'll have Christine Lagarde and the ECB press conference. Now, we had the Bank of Canada yesterday. If I just zoom up a little bit, you'll be able to see they very much kept rates on hold at 0.25. But what they did do, sorry, I'll just take this off just for 1 second. We'll put a squawk back on in a minute for the ECB roundup. But what we heard from the BOC yesterday was they're looking to tapering their government bond buying program by as much as 25%. So they are certainly the first central bank to pull the trigger on the tapering. The economy is expanding nicely. Things are beginning to recover. There's this pent-up demand picture, and we'll have positive inflation. And as a result, what they're looking to do is to taper a little bit the bond buying by as much as 25%. So they're the first. They are pretty much the first central bank to move. All other central banks are wanting to just sit tight for now, see how these markets play out over the coming months. Yes, things are looking quite positive, but nonetheless, it's like a cautious sort of take your time type of approach. So the Bank of Canada have kind of the first ones to step forward, and now the attention very much shifts to the ECB and Christine Lagarde in terms of the ECB's approach to their bond buying, massive bond buying program. And will there be talk of similar tapering at some point? And it's really about the time frames for these tapering and interest rate rises and monetary policy decisions being made. It's actually the time frame. If it fits with current sort of understandings, then we might not get much of an erratic move. If, like we saw with the Canadian dollar yesterday, and we'll have a look at the price charts in just a second, it was quite a significant move for the Canadian dollar. So we saw the Canadian dollar really quite strengthen significantly against the US dollar, which is probably a good pair to focus on. The only problem we had was we pretty much retraced the moves in the day before. So okay, let's just have a quick look. So at 12:45 we have the monetary policy statement out. The refinancing rate very much expected at 0, so no major shocks there we would not anticipate, and the markets will be listening very carefully to the tone, the wording that's used from the ECB president. So it's always an important event, and we'll keep a close eye on the stimulus, the quantitative easing monetary policy package which is in place, and see how the ECB are thinking that's going and what's likely to happen in the future. Okay, so we'll have a very, very close eye on the euro dollar during this event. We're just looking at some markets on other screens. There's a couple of potential opportunities elsewhere, which we can just look at. It's right now, it's worth just keeping an eye on the treasury yields and see how they're impacting the equity markets. Broadly speaking, we're kind of flatlining really in and around that sort of 1.55 to 1.57 sort of level. So you can see it's just actually rolling a little bit lower as we speak. So that's a little bit on the bond yield. Yeah, David, good afternoon. I hope you're keeping well. Okay, you're short the gold market around the 1790 level. There is an important more longer term level of resistance around that particular price. So yeah, or to go long above the retest of that point, which you've not entered into yet. So yeah, and we'll technically have a look at that, because there is an upper trend line cutting through that particular price. So it's an interesting price point that you've brought to the table there. Yeah, you're long US oil above 61.50. That's a brave trade, but I understand we didn't really get the crude oil inventory number yesterday that we were ideally looking for. So we saw oil start to sell off even further. Oh, you've not entered either. You're short pound Swiss at 27.49. Okay, look, we'll have a look at those now in just a second. So without further ado, let's get up our charts. I suppose the easiest place to start really is the US indices markets, so we can try to determine whether these markets are in a risk on or risk off market condition. If they're risk on, it means we can look at some correlated markets like the dollar weakness trade and capital coming out of your safe havens into the equity markets, and vice versa is true as well. If we're in risk off, then we can see capital flooding back into the dollar and the yen and markets like the gold market. So where we at yesterday, we had a really strong reversal from these lows. So been a bit of a rubbish old week this week so far. We might get a little bit more clarity. 4 or 5 days of pretty rubbish opportunity where kind of prices are, broadly speaking, reluctant to break with any sort of major momentum. So we are getting this sort of consolidative picture in these markets, and that can be extended across a number of these. Just looking at crude oil, if you zoom right the way out in this market, and we just take this high and just bring it somewhere down. Let's bring it down a little bit further. Then this market has interacted with these levels at a number of occasions, and now we're back at this little zone here. So we can absolutely anticipate a little bit of weakness actually in the gold market as a result. So then we can zoom in and we can see if that is a viable opportunity. So we're trading right through that sort of basically the $1,800 level. It's just inside of this zone. We don't need to be too tight with it. There's a $20 probably range around this sort of price. So so yesterday we pushed right up to that level. We would be interested in and you're quite right, David, in a continuation trade, probably above the $1,800 level. But what we've seen is we can expect a little bit of selling begin to creep in, and that's pretty much what we're seeing. How valid is that selling? Well, if we close today and we were able to break tomorrow below the 1783, then we would probably get a corrective move back to sort of the 1758 high. So I think you said you were short, yeah, the gold, and your stop loss probably above these two highs, I would imagine, the 1797. So yeah, hopefully you'll get, you know, a positive risk reward on that trade to the downside. To the upside, we want to see kind of a more constructive floor being created, and then the volatility to the upside. So that's gold. So we'll keep an eye on that. And like I was saying, like, what sort of picture is the dollar in? Well, it's selling off against the euro. It's mildly stronger against the pound. Weaker against the yen. Weaker against the Swiss, as you can see. The dollar CAD. I suppose we're at the weaker points of this like 1 month long grinding price action, but we're down at these lower levels. So can we break through to the downside? That's the big question. So far the answer is no. We would have absolutely expected some continuation below the 124.57 in the dollar CAD. Didn't get it yet. We'll keep looking for it, but certainly not yet. So we haven't been able to sort of pull triggers really on many of these markets just yet, but we will be looking to hopefully do some pretty soon. There's your price action really in the Aussie dollar, just in this little zone, just sitting in here, and it's quite a tight range as well. 77.61 down to 77.20, maybe something like that. So, you know, we're talking about a 40 pip range. Okay, we're getting prices pushing higher, but there's the rejections that we need to take into account to the upside and also to the downside. So our market condition, and we talk about market conditions all the time, is that it's moving sideways. So we need to get those markets closing above or below those levels to give us a little bit more confidence in the trade. So really it's about trade selection. The euro is really strengthening so far against the dollar. We do have the ECB now in 15 minutes. So the last thing you want to do is get into this trade right now with the ECB in about 15 minutes time. You might get really strong volatility around that time, spikes higher, spikes lower, whatever the case may be. So that's the so really it's about trade selection. So we'll have a look at the markets that we were, you know, feeling a little bit more comfortable about. The first one is the dollar Swiss, and again what the euro is doing is likely to impact the Swiss franc. So you know, we're so close to the ECB now. We'll just see how the euro and the Swiss play out, but a viable sell trade to the downside for the dollar Swiss. I think, David, you mentioned the pound Swiss. So so you're short the pound Swiss, and that's exactly the right way around. So the dollar is stronger than the pound, and the Swiss is stronger than the dollar. So again, we kind of go back to our strength versus weakness indicator. And what that means in real terms is the strongest market is the Swiss franc. Then you kind of have the US dollar somewhere in the middle, and then by far the weakest is the British pound. So looking to trade the Swiss and the pound is absolutely a good trading opportunity. And of course you want to buy the Swiss strength and look to sell the pound. So the pound Swiss franc to the downside is absolutely the right type of trade, and that's not even looking at the market. It's just purely getting the opportunity on side and making sure that the correlations fit. And there you go. That's your move. So, okay, it's not blowing the doors off, is it really at the moment? But yeah. So if we zoom out, we do a little bit of. So we know this market looks like it's kind of rolling over to the downside. We had our impulsive move lower, and now you wouldn't be surprised to kind of see that move. So looking at a pound Swiss sell trade is not a bad shout at all. And you've got a clearly defined stop loss just up here at the 28.13 level, and your entry 27.25 level. So this is on a daily time frame, so you could probably find a daily high perhaps or something. Let's see what that is, the 72. So you're looking at a sort of 40-50 pip stop loss really if you're looking at technical levels, technical highs and lows. Good afternoon, Finbar. Hope you're keeping well. Do you happen to be in any trades at the moment? If so, do let us know. So you're quite right, David, to look at this level in here as previous support and now resistance, and getting that little trade seems to be right now a good solid trade idea. So well done on that one. Okay, you're in gold, Finbar. Are you buying or selling? Because there's actually, we were just talking a little while ago, I'm not sure if you were with us then, but we were talking about the gold market. There's an argument to support it in either direction. So let's put on our squawk then, and we'll see what news updates we have regarding the ECB. So we've got an ECB news event out in approximately 10 minutes. So it's a gold buy trade. Yeah, there's it's just pulling back now. Do you mind me asking what price did you get in at to the upside? We were talking 2 days ago about the 1780 level. So was it around that price there was your entry?
So heads up then, we're on the 10 minutes now until we get the ECB rate decision. Widely expected to keep unchanged for interest rate and guidance with new economic forecasts due in June. Reminder, we do have a piece written by European editor Eric Kolb on the board and in the report section for those interested. Looking at a note here from Bank of America, they say this week's ECB meeting could be the calm before the storm. They say the outlook and the balance of risks have barely changed, and the ECB has delivered on its promise of more purchases. Bank of America expect the ECB to provide no additional guidance for the months ahead, leaving room for market jitters ahead of the June meeting. They say if the next generation EU fund gets up and running on time and economies reopen, comments on PEPP tapering will increase and the markets could get nervous. They say the risk of hawkish policy mistake can't be ruled out, but if uncertainty over the next generation EU fund drags on, it could be enough to avoid a hawkish mistake in June. They conclude without a properly defined policy reaction function, it would be only a matter of time, in their view, before the markets test the ECB again.
Okay, so the not just the ECB but all central banks, they do have potential issues to overcome regarding interest rates, and also some of the other monetary policy policy measures, such as their quantitative easing, their massive printing of capital and injecting that into the system through the form of bond buying. So,
and to make everyone aware, just ahead of the ECB, I am just going to do a server refresh.
Okay, yeah, so your entry was, that 1777 with a take profit of 1809. It's just, this is the area of focus now. So when I said there's an argument to suggest either a buying opportunity or a selling opportunity in gold, that's kind of where we're at the moment, because just look at this descending level. It's an upper trend line. Every time price gets to these prices, we get significant commitment from sellers to push prices lower. So we need to be mindful of that. The overall trend since up here at August last year, so last summer, we've literally been in this strong downtrend.
Here, following on from the server refresh.
So we've got this very weak market condition, and we'd be looking for opportunities to sell. And if you get turnaround price action, or you get a bit of exhaustion, or you get an opportunity to sell, that might be a trade to just be mindful of. So this is where effective risk management comes in nicely. So we shall keep an eye on gold. Let me add that to the list, and we'll put that on the chart as well. So we'll keep an eye on what's going on here. We'll have a look at it on a much smaller time frame. So let's look at it on something like the hour. So there's a bit of a double top here, a bit of a roll back over to previous support. So this is why there's an argument to suggest short-term upside, but it'll be interesting to kind of monitor price action inside this zone over the next day or so. Will we get that eventual move higher, or will actually these markets just actually roll back over to the downside? So with the equity markets pushing higher, you'd expect that to put a bit of pressure on gold. You'd expect a bit of capital to come out of gold and into your riskier assets. But we just have to sort of monitor this price action, see how it's performing. We might look at it on the daily actually, because we've got this important level. Okay, so let's put our trade plan together. We've got the minutes. Okay, so the first market, because of the ECB, is going to be the euro dollar trade. Yesterday we were talking about, would this market close below the 120? If so, there'd be some decent buying opportunities here. Below the 120, there'd be some decent selling opportunities. So yesterday we were looking to see if we'd get that continuation move, but that 120 became a strong level of support. So prices turned around quite aggressively and are now ticking to the upside. We're just coming into the ECB, so we're not going to make any decisions just yet regarding the British the euro. So we'll have a look at the euro due to the ECB. We also want to have a look at the dollar Swiss trade. So if we go to more recent price action, the levels that are of interest to us from a high probability trading opportunity perspective is if this price breaks below that. So we've been looking for some selling below the 92.84 previously as a much higher price, and now we've potentially got that next level opportunity. While I'm here, I might just change the number. So it's actually below the 91.50 level, 91.50. So we'll keep a very close eye on this. We do expect this market to push lower. We probably can expect the euro to continue to the upside.
We're just moving into 3 minutes now for this ECB decision. No change expected for interest rates and guidance. Quick note here from ING. They say in short, the ECB will look through any temporary increases in headline inflation and will not accept any increases in bond yields unless they are the result of improved growth prospects. ING conclude that the front loading of asset purchases was meant to support this view.
Okay, just having a quick look at the potential sell trade in the dollar CAD is more to do with the Bank of Canada yesterday, where they tapered their bond buying program by as much as 25%. So that's the first signs of, the central banks trying to get off the medicine which they've been dishing out now for quite some time. But as you can see, we've not really had the follow through that we would be looking for. So it's been quite a choppy market. It's not been a great market to trade. But below the yesterday's daily low, we'd expect further prices to the upside. So we'll keep an eye on the daily time frame for the dollar CAD. The New Zealand dollar. We can look at the New Zealand dollar or the Aussie dollar, but we just bring this in here. We've probably got slightly better opportunity now in this market to see if we get a breakout of this range. So if we look at it on the hourly, you can see that we've been largely drifting sideways. So we do have this important range here to the upside above the 77.60 or potentially to the downside, which would be running into previous levels of resistance. So a bit of support, perhaps around that 77,
just under 1 minute,
50 level. So we'll come back to these two markets and we'll keep an eye on the gold market, perhaps, as well. So it's just rolling over onto those highs. Right, we need an indice market just to see what's going on with the indices. We'll have a quick look at this. So nothing's really happening across the indices at the moment. The FTSE's selling off. The DAX is not really doing anything either, and we've seen a bit of strength in the Nikkei. So a bit of a bounce back there. So
10 seconds.
So let's put this level in. Put the gold, the Aussie. Okay, so let's focus a little bit more on the euro dollar and we'll experience this news event live on screen.
Unchanged. ECB leaves all rates unchanged.
So you probably got that bit of information there.
So the ECB reiterating rates at present or lower levels until inflation goal nears will keep providing ample liquidity and refinancing and teltros. Say the PEPP will run at least through to the end of March 2022 and will keep buying at 20 billion a month under the APP. The ECB also reaffirmed size of the pandemic purchase program at 1.85 trillion.
Okay. So no change from the ECB, in line with expectations. As a result,
that then the ECB saying that they will keep buying at 20 billion a month under the APP, saying that the PEPP will run at least through to the end of March 2022, affirming the size of this program at 1.85 trillion. They confirmed significantly faster pace of PEP this quarter. So the ECB confirming significantly higher pace of PEP purchases this quarter. And they also reiterate that they don't have a full envelope of PEP and they can increase. And they are to reinvest the maturing PEP bonds at least through to the end of 2023.
Okay, so it sounds like the ECB are going to be as accommodative as they can for as long as possible. So very much in line with expectations. And we'd like to see, what's the initial reaction in this? If we look at just something like the small time frames, what are we? Sort of 2 minutes in now. we're in this little 2-pip range. So to say that we've seen a reaction is laughable. There's a little bit of a very slight uptick. So what would our plan be for this? It's probably a green light.
Also saying here in particular, their latest operation in their third series, Teltro 3, has registered a high uptake of funds.
Yeah, the 4-hour range. So look, we're wanting to see if we get above. Let's see what that 2055. So that is the 100 period moving average, the 2054 level. So we've got the 2-day high just up here at the 2079. We've got 100 period moving average at these current levels. We've got Christine Lagarde shortly. So no significant change really just yet, which is fine. It's kind of what we were expecting, really. Okay, so let's just go back to our trade plan, and there's a couple of questions come in, so I'll have a quick look through those. The euro dollar is just at this 100 period moving average, so let's see how it reacts to this. We're not really getting that break yet below the 91.50 level in the dollar Swiss. Yeah, the dollar CAD, we'd want to break below these levels, the 24.73 level. In fact, this is a pretty poor response from yesterday's decision in with the BOC. So you'd expect further continuation. We just haven't seen that yet. The Aussie dollar is just in this little range between the 77.60 and the 77.38. So it's only a 20 odd 22 pip range in the last. These are all hourly candlesticks, so you're talking about the last 24 hours. And then we had 1 hour of sort of bullish price action followed by another day of kind of sideways moving price action. So we have to take that into account with these markets as things currently stand, is that the quality of some of the setups are not fantastic. They're not great. And we do get weeks like this, more so fairly recently than perhaps what we had a couple of years ago. But we've got to trade the conditions that we identify, and so we'll keep an eye on. So let's see what we've got then. So just looking at, sorry, Finbar, you just mentioned a couple of yours. Looks like it's dipping. So the gold market looks like it's dipping. Yeah, it's taking that little roll, but it's sort of sustaining itself around that sort of price. So maybe no major reaction too soon, perhaps. Also, the euro pound entry at the 86.05. That could be a decent trade. So yeah, there's that structural move where you get a bounce back, fails to create a new low, and we were talking yesterday about monitoring just this little high in here, the 84.42, and we're now, sorry, it's the 86.42, so we're now 20-25 pips further to the upside. So we can expect further upside in that for sure. And you got in at the 86.05, so you got in at this lower level. Like, that's just a risky kind of price, but probably you got into it like 4 days ago, perhaps. To the oh no, sorry, you're getting in on a turnaround. So buying a market below these 50 period moving averages, and they're just a higher risk trade, really, that's all. But yeah, the high probability trade is above the 86.42, which we're now above that. So and you'd expect prices to be pushing up to the 87.11, so you might get some good opportunities in that as well. Or sorry, you might get a good opportunity for continuation to the upside. The S&P is looking interesting. It's not really giving us anything. Oh, you had a sell trade in the euro pound. Okay, sorry, I thought you were looking for a buy trade. If it was us, we'd have to get out of that trade to the downside. It's proven above the 86.42 to be pushing higher, and it is supported with the more recent price action, the little breakout move followed by the pullback, and now we're probably likely to continue to the upside. So yeah, that's a tough one. I don't know where you placed your stop loss. As long as you've controlled that risk and you've made sure that you know how much you're exposing, then there's no problem in that in its own right. But yeah, you'd have to expect continuation to the upside from here, unfortunately. Oh, in the 4-hour range in the S&P. So we don't like it on the daily, and like, what would you be looking to do with this S&P on the 4-hour? Like, looking for the exhaustion trade, looking for yeah, do you know what, if you're buying the euro pound, it's one of those trades where you probably need to be quite disciplined and actually cut the trade. The caveat would be to, obviously, if you had your stop loss at a technical level, just because we'd expect price to continue higher over the short term. And look, if you cut the trade, and you'll obviously, you might take a loss on it, but you might get an opportunity to get into it at a slightly higher price. So that wouldn't be a bad thing, and that's what people don't forget. Like, you can still have your bias to the downside. And if you take a losing trade, you can still maintain that selling bias in terms of when the strength starts to come back into the British pound. And what it often means for us is that you can end up selling a trade at a much higher price, which is really what we're trying to do anyway. So you can take 1 or 2 losing trades to actually benefit on the next proper move. But it's just being patient for that trade. That's the difficulty. So yeah, so you're looking long. Yeah, okay. On the daily time frame, we can certainly look for trades for this market to just break above this tiny little range to 41.77. There's your buy trade. There's one big, or should I say, very significant problem. The all-time high is just a few pips above it. So, but there's, we'd expect these markets to be continuing higher over the short term anyway. So the dollar is showing signs, very mild signs of strengthening. So they are messing us around just a little bit today. Well, all week really this week. See, we don't have massive faith that the dollar is going to strengthen to any particular extent during this session. So to the 20. It's about the 2050 level. So there is a high probability buy trade above that 2050 level, which is your 100 period moving average. We're just backing off that level as we speak. Similar situation with the dollar Swiss. We do like that high probability sell trade below the 91.50, which is yesterday's low. We saw a bit of a move there today, and now we're getting that obligatory pullback, which we seem to be seeing regularly. The indices markets are really doing absolutely nothing. Bit of pressure in gold to the downside this time. We're just watching that. We'd expect the CAD to strengthen against the dollar, and it's not really doing that. Well, it's not doing that at all really at the moment, unless we get that little rollover trade and the the Aussie dollar.
So just a heads up then, saying the barriers are in place at 121 in euro dollar, and none of them seem to be DNT related like the ones at 120, according to Ryan at FOREX Flow.
Okay, it's 1 o'clock. Okay, Finbar, no problem whatsoever. Yeah, we can have a look at a couple of those later on tonight then as well. See how you get on with them. Yeah, listen, take it easy, and we'll see you soon. Okay, David, I'm just looking at that now. Yeah, listen, no problem, Finbar. We'll speak later on tonight, no doubt. Take care. David, you finally pulled the trigger on the gold trade. Yeah. If the same thing happens, which happens with this upper trend line, then it's got every potential to be a fantastic trade. Let's look at it on the smaller. Yeah, and you've got a nicely defined stop loss just up at these highs here. You got a double top. So your out and out sell trade is around the 1788. What's that level you put on it? Yeah, and now we're just going up and down and stuff. So yeah, it's got every potential to be a decent trade. Certainly high probability to the downside in today's trading. So will we get further commitment to the downside? From a probability perspective, it's looking like a decent sell trade. So very well done on that. How do you decide how wide a stop should be? Should I use price action or the ATR? Honestly, David, we use technical levels So we use price action. Price action highs and lows. The vast majority of the time, those are often daily highs and lows. It just keeps you out of that sort of intraday volatility, which is it can be quite severe at times with these markets at the moment. So previously they'd be a little bit tighter than that, but definitely those technical highs and lows on the daily time frame. So straight away the 1797 would be a 2-day high, and that would be a bit of a no-brainer technical place to put your stop loss, just above that level. We would also, the previous price action is pushing higher, so we would also be a little bit more aggressive with the sell trade, i.e. the buy trade you'd want to try and let it go, and then the sell trade you're wanting to not allow it to continue to the upside. So you actually, your mindset wants to be a little bit more aggressive with the sell trade. But yeah, to answer your question, we certainly intraday, on an intraday basis, day trading, we would use technical highs and lows. So if your entry is 1785, you'd have a stop loss at 1798 perhaps. We have a 2 times the spread rule, depending on the spread of the market that you're trading. So whatever the spread is, we times it by 2, and we place our stop loss just above the 1797.50, and we'd add 2 times our spread to the upside. And what that does is that stops us from getting stopped out like today's high. And those daily highs are really quite useful. And they're a way to remain disciplined, objective in your decision making. So you're not applying, 20 pip or 30 pip stop loss, which is what an awful lot of traders do. There's no sense in that, because you need to take the volatility of the market into account, and you're not doing that if you're just working with a standard level. And all markets are different, of course. So you might have a $15 stop loss in gold, and you might have a 50 pip stop loss in the euro dollar, or a 20 point stop loss in the S&P 500. So you're always each trade has its own unique characteristics, so you want to trade it as a unique trading opportunity. And for us, we predetermine how much capital we commit to these trades. So it's either 1% of our capital, 2 or 3% of our capital, depending if it's a no-brainer trade. And we calculate that using our software, our trade management software, so that we know exactly how much capital we're committing to the trade, and we put that trade size in. So if you look at our P&L and our trade size, they're all different depending on each market, because some have small, tight stop losses, some have much larger ones, but depending on the percentage, they'll all have the same amount of capital committed to those trades. So I hope that makes a little bit of sense. So yeah, we use those technical stop losses, and we use price action and swing highs and swing lows to sort of stay out of the chop if we possibly can. Just a quick one on the ATR, the average true range. We use that an awful lot on daily time frames. So like for example, last night we were talking about the dollar CAD. We've got if I just share our thoughts with you on the dollar CAD quickly on the daily time frame. So we've got a pending order in this market to the downside, largely off the back of the BOC yesterday, and the pending order is below the 24.58 level. So we were saying, yesterday that the CAD strengthened considerably. If we get follow through and prices break further to the downside, we can expect a decent move further lower. So we've got a pending order in that, and instead of using a technical stop loss all the way up here, that's your technical stop loss if you're trading daily time frames, we used an ATR stop loss, which was something like 90 pips or 80 or 90 pips, something like that. So our entry's at this level, and instead of having, I suppose, 150 pips stop loss, 150 pips, we've actually got like an 80 pip stop loss instead. So it just gives us that better opportunity to get that positive risk reward that we need before getting into a trade. When swing trading, do I keep myself from feeling the pain of the unrealized P&L? The straight answer is yes. If you're suffering from pain, you're probably trading, your trade size is too large. So what we would do is we just turn down the downside on any particular trade. Like I said, if you're day trading, 1% of your capital, while you're learning how to trade is more than enough. So work out what 1%. If it's a 10 grand account, you're talking $100 trade, and that's your exposure. So you're not awake at night wondering how it's going to perform. If you're trading 10%, if you're trading £1,000, then you go underwater, and you could be if you take a loss on that one trade, £1,000 is a significant amount, especially when you're starting out, and we wouldn't be encouraging that type of psychology to trading. And you want to make decisions when you trade that you want to try and remove the stress as much as you can. It sounds a bit dismissive, but when we get into a trade, we calculate our risk, we understand how much capital we're committing to the trade, and we'll let the markets take care of the rest. Meaning if it stops us out for a loss, and we do look to mitigate risk as quickly as we can. So that's one of the things that we're very efficient at. So we don't want to have any exposure in the markets if we possibly can. And then we can focus on letting those winners run. So if you work out what 1% of your capital is, whatever amount you happen to be trading with, then that will remove the psychological stress of the situation. And if you take 2, 3, 4 losing trades, you're talking about 3-4% of your capital, which if you have a positive risk reward, you can get back in 1 or 2 trades. So, and that's the important part. Trying to recover a trading account that takes 70, 80, 90% hit on your deposit, that's a very difficult place to come back from, because you literally don't have the capital to do it. So my advice, David, or certainly what we do when we trade is, if the stress of the trade is too high, we'll turn down the trade size so that it's a little bit easier to deal with. Yeah, and traders experience pain, and don't get me wrong, when I first started out, I found it a very, very painful environment. But it's not an objective. It's not something that you should be putting up with. Just turn down that the exposure on it, and the trade size. Take smaller trades, and actually build up your trade size the more experience you get, not the other way around. Listen, my pleasure, no problem at all. So what I'm going to do is I'm just going to put just see where we are with these markets, because so there we're getting the dollar to strengthen against the Aussie. And we're not getting any significant movement. So really the quality of trading in this session is pretty poor. Yeah, so the oil market is breaking. So there, that gold trade is ticking lower nicely. So let me see. So oil is breaking above my hourly resistance, which is what you wanted. Let's have a look at it on the hourly. Yeah, okay. I see what you're doing. So for us, yeah, good afternoon, Michael. Good to have you with us. Yeah, how's our week going? Poor quality trade setups this week. I think we would probably summarize it as we've not been hugely active this week because of that, because of this when we don't trade consolidation like that. And this is only just a brief example because it's up on trade, but you're getting long periods of kind of nothing followed by a very short period of a little burst of activity. Yeah, it's just one of these trading weeks because this is where our trade plan comes in, you see, guys. So for us, we plan our trades way in advance of getting into them. So what we then need is the market to follow through with our expectations. If they turn around and do the opposite, then we're patient. We back off. And you're quite right. Was it David? Did you mention the crude oil market? Yeah. So look, this is on an hourly time frame as well. So we are having 2, 4, 6, 8, 10, 12, 14, 16. We have 18 hours of just sideways moving price action, largely off the back of yesterday's crude oil inventories. And now we'd expect certainly a little bit of short-term buying creeping in. So there's no doubt there's a short-term buy trade for now in the crude oil. The problem is we generally focus on high probability trades, and we want to go with market trends, and we want to identify the trend of any particular market, and we want to go in that favor. So what we don't do is buy the lows. We don't sell the highs. We do on structural failures, either pushing higher or pushing lower, which is really what we're seeing right now. So there is a structural failure trade now to the upside as we speak. So it is a viable opportunity for those of you that do want to look at that. Elsewhere, it's been a bit of a poor week. If you look at things on the daily time frames, like the Aussie dollar, we're up and down, and that's the prevailing. We're kind of retracing certain moves within the week. So we're wanting the clarity. We're wanting something to fit nicely. If we look at the S&P, yesterday we retraced the previous day's move. Now we want this market to break above the 41.76, and it's not doing so. So yeah, the opportunities are not kind of jumping out at us just yet. We're kind of monitoring a whole variety of different bond yields, and we're wanting to try and get the correlations right if we can. So yeah, David, you said you agree poor quality trades. Yeah, is it summer markets? Yeah, I mean we'll probably have a really active summer this year. You can imagine all these economies coming back online, and there'll probably be an awful lot of activity. Yes, your institutional traders will be off for the month of August, and we generally take a couple of weeks off in August every year, largely because you're sitting around looking at markets that have really sort of low volatility. So it's probably the best month of the year to take some time off actually from trading if you possibly can. But this year, it's COVID changes things. It kind of changes, the fundamentals behind many of these markets. And will we be exuberant and lots of positivity, or will this virus come back again in whatever guise it might take? And will we have other issues with vaccine rollouts and things like that? Will it be a kind of more of a negative summer? We would anticipate, and we would anticipate really these markets to be really quite bullish over the summer months, and certainly we'd be preparing for those. Yeah, so Michael, you've been reading up on the concept of liquidation. Yeah, liquidation. Like, what specifically are you talking about? Liquidity, or are you talking about liquidating like a company? Just expand perhaps if you can, and I'll see what you mean. Yeah, do you understand seasonality? I think seasonality and commodities would be very powerful. To a certain degree. Certainly James would be the person to speak to here regarding a lot of your commodity markets and the impact of seasonality, and we've got quite a bit of education on it as well, in one of our courses. So yeah, I've got a sort of a basic understanding of it, and the future markets will take that cyclical kind of seasonality into account. So you can just get really good opportunities at certain times of the year. So, for example, the demand for oil is likely to increase over the winter time because obviously people will need their houses lit and heating and things like that. So you might get a seasonal uptick during the winter months, and the same during the summer time. The demand might just tone down a little bit, and as a result you might get a bit of softening in crude oil. But that's just a very crude kind of understanding of it. It's a lot more technical, and like I said, James does track and follow the cropped reports and all the rest of it. So what's your thoughts on it? Are you looking at any specific markets? Is there any specific markets that you're perhaps referring to? Yeah, what sort of context, Michael, do you mean regarding liquidation?
We're just under 10 minutes now until the bottom of the hour. We get US data, initial jobless claims. We're looking for it to move higher to 617,000 on a prior 576,000. The range 550,000 to 700,000. Continuing claims, we're looking for 3.667 million. It to move down on the prior 3.731 million. The range 3.55 to 3.845 million. We'll also get the Chicago Fed National Activity Index for March. We're looking for it to move higher to 1.25% on a prior negative 1.09. A reminder as well that ECB's President Lagarde will hold her press conference. Just a quick note from TD here on the initial jobless claims. They say last week's 193,000 plunging claims was consistent with strengthening in the labour market, but at least some of it can probably also be explained by the normalisation in the relationship between the claims data and other labour market data. TD today looked for a 625,000 printing claims for the week of 17th of April, up from last week's 576,000. They say the trending claims was around 215,000 before COVID, and they suspect claims have been boosted by a surge in fraudulent applications, as well as a relaxation of the qualification criteria during the pandemic.
So these are the levels at which and the direction in which we're looking for these markets to move. Gold is just in this little indecision little point at the moment, so we're just kind of monitoring some of that price action, but we're looking for the euro dollar to push higher above this little 100 period moving average. We're looking for the dollar Swiss to tick lower below the 91.50. We're looking for the dollar CAD to break below the yesterday's daily low at the 124.58, so we're a little bit off that, and we're currently pushing lower, but previous price actions pushing prices to the upside. We had a strong rejection, and we're just sort of trading consolidation really. So I think Michael, you just mentioned you know, some of the opportunities in this market just have been more grinding than, you know, explosive and things like that. So not specifically, but you keep your eye on seasonality right now. You're looking at coffee, soybeans. I see a lot of people trade those. Yeah, they've got a little bit of specialtyism, I guess, in that, and they understand the how those particular markets work, and that's really quite important for any particular market you trade, to understand what influences and what impacts it can have. Yeah, coffee and cocoa, they're all very seasonal. They all, you know, hit certain difficulties with cultivation and soybeans, you know, crop failures and things like that. So they suffer from all those sorts of things, and you just need to be mindful. I remember we were trading a lot of cocoa, actually. I think it was about 4 years ago, where there was a sort of a shortage in Western Africa, and forgive me, was it flooding related or some sort of natural disaster, and it really impacted and the prices you know, pushed higher. So there were some interesting trades for a few months really in that. Yeah, the liquidity. Okay, so liquidity and how banks hunt for people's stops. Yes, yeah, that's absolutely the case. They create a bit of liquidity by pushing a market in the opposite direction to the direction in which they want the market to move. So they might take a certain amount of a trade size for prices to push higher, and then look to sell at certain levels. So they do it. The problem is it's a very high risk strategy for them to do it, because if they get caught offside, you know, they can pay a big price. So it's really about the management of risk. But you can build that manipulation almost into your strategy and approach. So we spoke earlier about technical stop losses, and you know, if you have a couple of levels, you know, which are natural technical levels, and you're looking for a sell trade, we'll always work with the higher level if it's marginal, just purely because you can get prices pulling back to the first level, take traders out, and then kick on to the downside. So yeah, we kind of build that understanding, I suppose, into our stop loss placement, if that makes sense. So they certainly create liquidity, and with other buyers in these markets looking to jump in on those signals, it creates a lot of activity. Otherwise, markets can pretty much drift sideways for prolonged periods. But they've got to be selective about the markets that they do it to. Yeah, so you are new to trading, and you're trying to gather as much information I can get to become a better trader. That's That's absolutely it, Michael. That's exactly what we do at traders every single day.
To 3 minutes now for this US data. Initial jobless claims, we're looking for an increase to 617,000. The range 550,000 to 700.
I'll just post that. So yeah, information is knowledge. Far too many traders, they don't want to give themselves the opportunity to learn what they need to learn. There's a lot to it in this environment, and there's a lot to sort of take on board. It does get an awful lot easier with experience, but most traders don't want to give themselves that opportunity to kind of learn this environment. So we'd absolutely be advocates of taking your time, learn how to trade, learn how to identify the opportunities, where to be getting into those trades, how to trade them, how to manage your risk before you enter those trades, trade management, and then the psychology as well. Sort of, it's all encased in psychology. So yeah, there's quite a bit to it. We might be able to help you, Michael, if you want to have a quick look at our website. You'll see kind of some of the daily trading live trade rooms that we offer, and it's really based around knowledge and understanding about what's happening in these markets and where the opportunities lie and how we're looking to get into them. We help traders for as little as $15 a month, so it's not a significant outlay. We trade markets every day ourselves, so it's just broadcasting kind of what we do and what we know, and having someone to bounce off as well. Someone that you can trust. There's unfortunately in this environment there's so many con artists, so try to find someone that can help you really. So let me see. So sorry, David. Banks do not hunt stops. This narrative was created by ICT. If you look at price as an auction, when price pops below a range, that's super cheap in comparison to the range. So somebody buys it up. Yeah. Most people just happen to put their stops there. Yeah. If you see like a liquidity ladder with all the institutions used, they'll see exactly where the orders are placed, and that's a liquidity ladder or liquidity run or whatever it's called. So you can actually see where those markets. So I suppose retail traders can get caught up in that, but they don't look at price charts in the same way that we do, especially if you're day trading. They've got a kind of a completely separate system, which would actually cost you quite a lot of money to be able to get access to. So they do have that advantage. How we offset that is we can see the momentum of their trading in front of our very eyes. So we can see price and volume, and that tells us what they're doing, even though we can't see the same screen as them. So and we use technical levels to work out where the capital is moving to and what's moving markets. So it's kind of something that's parallel. It's not quite. We don't look at the same information as they do to a certain degree. They've got a wealth of very expensive information that we just don't have, and to be fair, we don't particularly need it. We're not scalpers. We trade bigger time frames for that reason. We're not competing against all of your trading bots and things like that. We want to see capital come into a particular market, and if it meets our criteria, then we'll execute a trade. If it doesn't meet our criteria, like it's doing at the moment, it's not really following through, then we'll back off and be nice and patient and wait for those better opportunities to arrive. So yeah, there is a high degree of probably more retailers placing their stop losses at very specific levels. I would agree with that for sure. Because newer traders believe heavily that they need to put a tight stop so they get stopped out, but banks trade against each other. Yeah. Like there's lots of high-profile cases where banks collude as well, and a lot of that is supposed to be dismantled, but does it? Tough one. And also make money from the spread. Yeah, they do indeed. So you're still new to this, yeah, and you're trying to gather much information. That's exactly what we would look you to do, and what we recommend every single trader to do. It's not all about putting, 20 grand in an account and blowing it up. That's a really stupid way to learn how to trade. Do start with a small amount, but you can start with a relatively small amount and just ignore the P&L, ignore the amount of capital you're trading with. Just practice the skill of trading a certain percentage of that capital. That'll put you on the right track, and then you can increase or you can decrease your exposure depending on how you're performing, and that'll give you the time to kind of learn how to trade. These financial brokerages are seeing exponential growth in terms of revenue and profit, and they're doing that because there's an awful lot of retail traders flooding to this environment, and they're putting loads of money into the trading account and they're getting burned. They're burning multiple accounts. We know of many traders that have done that before they've come to us, and it's a path that you don't really want to be on, and it's just because they know very little, and they take on too much risk. So if you can increase your education, like you say, and you can reduce your risk, then you can be in the markets long enough to trade them and to understand how they work. And that's something that we've always advocated. Yeah, also retail traders make less than 10% of the market. I don't think banks focus much on us. Retail traders are the easy money. So you probably look at all your brokerages that, 70, 80, 90% of traders lose their money. So it's easy liquidity for them. I think that percentage is growing recently. It used to be around 8%. You might be right. It might be up at around 10% now, but wouldn't surprise me if it's been growing over the last couple of years. So Michael, do you open and close trades with the day or within a couple of days? Really good question. This is you've got decisions to make when you trade. You've got to decide which markets to get into, which markets to choose, where to get in, and where to get out, how to manage your risk, how to manage the trade once you're in it, and you've got to deal with the psychology. So there's quite a lot that you need to take on board, and you need a kind of a strategy for each. So regarding where to get out, what we use is we let the market determine when we exit. So we don't have a prescribed, if we take a 30 pip risk, we take 30 pips profit. For us, we cut our losers short, but we want to let those winners run. That's kind of the approach that we adopt. So there's reasons why you get into a trade, and we also look for those same reasons to get out of the trade. So when it comes to closing a trade, we're not prescriptive. We're not the reason being is, why would you limit your profits? Limit your losses, absolutely, that makes perfect sense, but don't limit your gains, because you never know which market is going to fly, and you can bank an awful lot of capital return in a very, very short period of time, and you don't need to have, we see lots of educators out there with sort of 80-90%. Just looking at the euro dollar as well on the screen, 80-90% win rates. Win rates mean nothing if you're booking in 5 pips profit, but you're risking 100 pips if you get it wrong. So be mindful of those that talk an awful lot about win rate. It's far more important, your the amount of capital that you the return that you get for the capital that you expose. So if you can imagine 90 trades, you're making 5 pips per 90 trades. If you got a win rate of 90%, 90 trades, you make 5 pips profit on every trade. You're doing fantastic. Great. 90 times 5, what's that? 450. So you've made 450 pips profit. But 10 out of every 100 trades, you take 100 pip loss. So you're spending all your time in a negative risk reward trading strategy, making 450 pips when you're getting it right, and out of 100 trades, you're losing 1,000 pips if you're getting it wrong. So be mindful of that. For us, we want to cut and limit our losses, and we want to let those winners go. And some of the strangest trades we get into are probably our biggest returns, because we don't want to limit that profit, and if it flies, we want to let it go. So that's what we're looking to do. Yeah, so it is up to you. So you're absolutely right. So with that in mind, in terms of closure, most of our trades are probably maybe 2 or 3 days, because we get into some profit and we look to book in as much profit as we can. I'd say our average trade length is probably between 2 and 3 days, but that's more to do with these market conditions over the last year or two, where you get an explosive move and then you drift sideways for a while, and then you just get that next move, and it's very sort of in stages and in levels. So because of that, we just give it a little bit more time. If you asked me that question three years ago, we'd probably be in and out of most of our trades probably within the day. So that's how things have kind of evolved a little bit for us. So yeah, David, you've blown a couple of accounts, but they were like £20 accounts. Yeah, look, that sort of level of exposure is fine, but there's reasons why you're blowing up the account, and it'd be a case of just looking at those reasons, using set rules and following them. Yeah, that helps. That all that does is keep you on the straight and narrow. It just makes sure that that those rules are not subjective, but are objective if you possibly can. So that's why we use an awful lot of daily highs and daily lows, because what you can't do is argue with the daily high or the daily low. It is what it is. We can get that number and we can work with it. And structural failures are what we regard as definitive. They're those psychological shifts in those markets, and we're in tune with those, and that's what we look for. A good example was the what's going on here with the we've been in a sideways moving pattern, and we've just recently broken to the downside. So there's your high probability sell trade in there in the Aussie dollar. We're just not looking for a sell trade, because if you zoom out a little bit more, this market has been doing nothing but drifting sideways now for quite a while. So we're in this sideways moving zone, and we don't want to be identifying these little small trades in at these levels. We actually want the big picture trade. So thank you very much for all your questions, guys. I do apologize. We've got other sessions with traders now, so I do need to pack up. Yeah, absolutely, David. Yeah, look at the equity curve and not the win rate. It doesn't mean an awful lot. You specifically want to only trade currency, but not into stocks. Yeah, the only problem with currency is we trade the indices, oil and gold, and the currencies because we see the correlations. We see the fact that if equities push higher, we can look to sell the dollar. If the equities push lower, we can look for opportunities in the yen, the dollar, and the Swiss franc. And all of a sudden, the gold market, we can always put these correlations together. Nothing moves and works in isolation. It always impacts other markets everywhere. So we want to be mindful of what's impacting other markets. So you might have heard an awful lot recently about bond yields. They're impacting the equity markets to quite a significant level at the moment. So as a result, we kind of monitor where is it, the US Treasury market, the 10-year note. So we're seeing what's happening with that price, and is that going to impact the equity markets? If so, we might buy if it's low, we might sell if it's high. So it's taking all of this information into account. I don't want to sort of confuse you guys too much, but the more information you have, the better trader you'll become. Currency, the biggest thing I've learned is currency correlations. Yeah, absolutely. Not into stocks or Bitcoin, are you probably saying? Yeah. So the cryptocurrency markets are just they're just casinos. So have a lot of money going in, and good luck in keeping it. You might triple your money, quadruple it, whatever. But you might lose it and leave it behind you as well. So it's far too volatile. I think I've learned here to compare all charts against the US dollar. It helps. I know, David, you mentioned, I think, the dollar Swiss. So very, very easily you can compare and contrast the pound and the Swiss franc against the US dollar. So the dollar is strengthening considerably. The Swiss is only marginally stronger now than the dollar. But just with this basic analysis, you can then, it gives you a bit more confidence in that pound Swiss trade, the sell trade, the pound Swiss sell trade. And as long as this correlation remains intact, then you would expect the pound Swiss to continue to the downside. So really, we're talking about pound weakness is the trade. All the main pairs. So see the strongest currency, that's strong in all of the different pairs, yeah, and the weakest across them too. Yeah, you can do a very quick analysis to work out which currency is stronger, which currency is weaker, and put them together. It's a combination of reward to risk ratio. Yeah, so we risk 1%, we look to get 2, 3, 4, 5%, maybe even 8, 9, 10% back on any one trade. And because we have that psychology and approach, we could take 2, 3, 4, 5 losing trades back to back. That's not uncommon. We experience that all the time. But the point is, we get that one trade, we could get 10% back on that one trade, or 5% or 6% or whatever. So that keeps you on the right side. And market conditions ebb and flow. So sometimes you get green lights to you get into 5 trades and make money on all of them. So you've got to take the environment into account. Yeah, it's a combination of risk reward, yeah, and strategy. Yeah, would using a strategy with a small account still be viable for account? You see, with smaller account sizes, you're just limited in terms of what you can do. So you can't trade the correlations. So you can't trade the euro dollar, for example, and then you might want to take a trade in gold or oil, and it's far more expensive to do so. So if you have very, very small amount, then you're prohibited from doing so. One brokerage you might want to look at, which is a brokerage that we offer traders as well, as FOREX. The reason why I suggest them is most brokerages, they offer sort of 10 cent per pip movement in markets like the euro dollar. whereas InstaTrade, they offer 1 cent per pip movement. So they are by far the most affordable brokerage out there. And they're EU regulated, and also they're regulated outside the EU as well for increased leverage. So you've actually got both options there. We're putting a matrix up on our website now in the next few days or a week or whatever, and it'll explain those options hopefully very, very clearly, because it is a bit of a minefield for traders. So that might be an option for you if you've got, you know, a really small amount of capital, because it means you have a greater potential of being able to trade the S&P, the euro, and the oil and gold, and you're building up the skill set, but with a small exposure in terms of capital. So that might be an option for you. It is for some of our traders that don't have that much capital to trade, but obviously they want to do so. We generally don't recommend using a demo platform, because it's not the same as trading with live capital. You know, you experience, you know, slippage and spread widening and all sorts of stuff in normal market conditions that you're not picking up from with that you're not benefiting from if you're trading with a live capital. So if you've got a small amount, you know, look at something like FOREX. They would be probably a decent option to choose, and it just means you can deposit with lower capital and get into you know, correlated markets at the same time, depending on obviously how much capital you have. All right, so euro dollar, it's kind of ticking to the upside. The pound's taken a bit of a beating, really. It's just a pullback off the high, so we're actually looking for a buy trade potentially when this market turns around, but clearly not now. The yen, so I do need to pack this up. I do apologize. Thank you very much for all your comments and our discussions. It's been fun. Right, we don't have this session on Fridays, so just Mondays to Thursdays at the moment, but we're here at 12 o'clock. And if you want to join us next week at 12, feel free to do so. We'll prepare as always, and we'll give you your insight, and we'll help you along the road as much as we can during the session. The dollar CAD, it's just purely indecisive. The Aussie dollar, you'd expect it to squeeze lower short term, but we're looking for the high probability trade in that. New Zealand dollar, it's just rolling over. So again, a decent move is above the 2-day high in here, the 86.42 level, and it's really euro strength and pound weakness. Those are, the euro is one of the strongest markets, and the pound is absolutely one of the weakest markets as well. Euro yen just reversing off yesterday's low. The pound yen, it's about pound weakness today, and the pound isn't in a great spot to be that aggressive with at the moment either. So that's a bit of a pain. Gold, we'll see what happens on the close tonight. Tomorrow we might get better opportunities there. Crude oil, it's ticking higher. The overall sort of more recent price action is to the downside, so just be mindful of potentially this market, you know, continuing its roll lower. So pay attention to risk management. And so the S&P above the 41.76 is a viable trade if we get that opportunity. It looks like the equity markets are threatening to look like they might squeeze higher, but we've had a good bounce actually off this triple bottom in the Nikkei. So look, on that note, guys, we'll have to let you go. We've got other traders and sessions with them, so we'll pack up this free session. So we'll be back again Monday to Thursday at 12 noon. So if you can give us thumbs up, that would be great, or subscribe to our channel. We do have an awful lot of content coming online now over the coming weeks, so we're slowly getting back on track after a pretty disruptive last 12 months with this coronavirus. And I'm sure it's the same for you guys as well. So yeah, so on that note, for more information, go to our website, thelivetraderoom.com, for more information. We'd be happy to kind of talk you through things. So from everyone here at the Live Trade Room, thanks for joining us. Have a fantastic weekend, hopefully, and we'll see you all next week. So from everyone here, take care. Bye for now.